Every single second, the global financial machine spits out millions of data points, tickers flashing, prices jumping, and fortunes seemingly made or lost in the blink of an eye. It looks like chaos. For a regular investor trying to build wealth, the financial industry presents a stressful choice. The standard narrative is that you either pay a professional to manage your money or you spend your own life becoming a financial expert to keep up with the data. This table shows the logic we are taught to follow. Active trading supposedly requires high expertise to beat the market average. Meanwhile, the passive approach requires zero expertise, but is framed as settling for average returns. This is a false dichotomy designed to justify the fees the industry extracts from your portfolio. Our goal today is to examine how to avoid losing a fortune to unnecessary costs and emotional mistakes over your investing lifetime. Economist Burton Malkiel challenged this entire system with his book, A Random Walk Down Wall Street. He proposed a theory that targeted the core assumptions of professional money management. Malkiel famously claimed that a blindfolded monkey throwing darts at the stock pages of a newspaper could build a portfolio that performs just as well as one carefully selected by top Wall Street analysts. His argument rests on the random walk. This is the mathematical concept that future stock price movements are not predictable based on past history or current data. Tomorrow's price change is independent of what happened today. We are going to test this by weighing the three main investing strategies: fundamental analysis, technical analysis, and passive indexing. We'll look at the specific costs and returns of each to see which one actually rewards your time and money. If the market behaves like a random walk, then attempting to outguess it through active trading creates a structural handicap for the individual investor. We'll start with fundamental analysis. This is the strategy used by most of Wall Street, based on the belief that every stock has an intrinsic value, grounded in the company's real-world business performance. On this effort chart, fundamental analysis requires a massive time commitment. Analyzing balance sheets and future cash flows to arrive at a theoretical value takes hundreds of hours. You aim for a higher return by buying undervalued stocks, but the margin of error is significant. The problem is that the data you are analyzing is often flawed. Companies frequently spin their earnings or provide misleading information, especially during periods of high market optimism. If your starting information is garbage, your conclusion will be too. Even with perfect data, you are vulnerable to events that no balance sheet can predict. An earthquake, a sudden regulatory shift, or the death of a key founder can instantly invalidate months of careful valuation work. Fundamental analysis provides a sense of control, but in a chaotic world, it still relies on the hope that human forecasting can outpace reality. The second strategy, technical analysis, ignores intrinsic value to focus on crowd behavior. This is the castle in the air theory, the idea that a stock's worth is whatever someone else is willing to pay for it tomorrow. Technical analysis sits high on effort and low on reliability. Monitoring charts to predict the herd is useless because high-frequency algorithms capture the profit first. Furthermore, frequent trading heavily drags down your returns through transaction fees and capital gains taxes. Beyond just the math, active management introduces a massive variable that most people simply cannot control: their own psychological biases. Humans are prone to herd mentality. When everyone around you is making money on a specific stock, the fear of missing out becomes overwhelming. This social pressure causes many investors to buy into bubbles right as they are about to burst. We are also hindered by loss aversion. We feel the pain of a financial loss twice as much as the joy of an equivalent gain. This often leads investors to irrationally hold on to losing stocks for years, hoping for a recovery that may never come. Active trading isn't just a mathematical challenge, it's a psychological one. It puts you in a position where your natural instincts often lead to the most expensive possible decisions. This leads us to the third path, passive indexing. This approach is based on the efficient market hypothesis. The idea is that in a modern, interconnected market, all available information is already priced into a stock. Because millions of people are constantly trading on the same news, trying to find an undiscovered edge is practically impossible for most investors. Passive indexing offers low effort and high reliability. You buy low-cost index funds using dollar-cost averaging. By investing a fixed amount monthly, you buy more shares when prices are low and fewer when high, smoothing market volatility into a steady upward trend. This strategy requires you to accept being average. You give up the excitement of picking winners and the hope of hitting a jackpot. You also need the discipline to do absolutely nothing when the market crashes and everyone else is panicking. This is a trade. You give up the illusion of control in exchange for low fees, zero daily work, and a historically high probability of long-term wealth. Because individual stock picking is so difficult to do reliably, your primary job is asset allocation, deciding exactly how to split your money between stocks and bonds. This depends on your personal tolerance for volatility. JP Morgan famously suggested that if you are losing sleep over your investments, you should sell down to the sleeping point. You need a plan you can stick to when the market is red. This decision tree helps determine your path. For the overconfident DIYer who is currently spending hours a day trading, the data suggests that active trading is mostly benefiting your broker through fees. Moving to passive indexing is the most logical way to protect your long-term returns. For the professional with very little free time, there is no need to become a market expert. Your optimal path is the middle branch, automated contributions into broad index funds that grow while you focus on your career. Finally, if you are a beginner, your age dictates your risk. A young person with 30 years of runway can afford a high percentage of stocks, as they have time to recover from any crash. If you are close to retirement, you pivot towards stable bonds to preserve what you have earned. In the world of investing, you get exactly what you don't pay for. By keeping your fees low and diversifying broadly, you allow the simple passage of time to do the work that most professionals cannot.